Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my partner, Chen Lin, publishes What is Chen Buying, What is Chen Selling, and you can subscribe to both of those letters at miningstocks.com, miningstocks.com. I want to encourage you to keep sending along your questions, answers, or your questions, criticisms, praises, whatever is on your mind to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com. We want to thank our sponsors for making this show economically viable. Today, our sponsors are New Legacy Gold, Novo Resources, Klondike Gold, Aran Resources, and Ariane Phosphate. Well, I've titled today's show, Is Brexit the Start of a Global Movement? Richard Mayberry, Eric Coffin, and Michael Oliver once again will be with us today. The Brexit vote was a shock to the establishment, and similar reactionary movements, though, are being displayed throughout Europe, including two of the largest countries, Germany and France. The Italians are restless as well and are in deep financial trouble. And of course, the U.S. We have Donald Trump, and he's gaining a huge amount of traction from the middle class that is being destroyed by both Democrats and Republican governments that have engaged in massive deficit spending for guns and butters and whatever else they can their hearts dream of. To top it off, the worst offenders and destroyers of our prosperity and ultimately our liberty is the Federal Reserve Bank and other central banks around the world as well, because they are engaging in price controls for capital. Deficit spending and taxing to pay for unnecessary programs is harmful enough to the economy, but the death knell for our capitalist system is being orchestrated by a Keynesian-oriented Federal Reserve that is not allowing the markets to price the true rates of interest that would result in just the right amount of saving, just the right amount of consumption, and just the right amount of capital allocation to just the right industries and to just the right companies within those industries. That, my friends, is what would happen if we had a true free market for capital. But the powers that be don't want to have anything to do with free markets, apparently. The arrogant PhDs from Harvard, Princeton, and Yale, no matter how their university entrance scores were, no matter how high they were, are totally ignorant of the most simple and common sense market dynamics of supply and demand. And so our markets are being totally destroyed, and that is leading to impoverishment of the middle classes. And so we have a reaction. We'll be talking we'll be talking to our various guests about this, but certainly Richard Mayberry, those are some topics we'll want to put to him as well. With regard to gold, the price fixing of interest rates at negative real rates of interest is perhaps the single biggest driver for the price of gold from a fundamental point of view. I have just written an article in my newsletter this past week, and I expect it will be posted at miningstocks.com very soon, drawing from the work of Paul Wong. He's the head portfolio manager at Sprott Inc. Well, I met up with Paul last week in Toronto at the Sprott meeting that was for some of us newsletter writers. Paul is very bullish on gold, and he thinks that shares have risen only about 20% of where they're likely to rise in this bull market because of negative real interest rates and the direction of those real interest rates. Now, Paul says the only thing that he sees that would convince him that the gold bull market is over, and I'm sure he still feels that way after today's downward slug, he says the only thing that would really convince him that the bull market in gold is over is if GDP around the world would start to rise. Well, I don't know if you've noticed, but just today or yesterday, the IMF put out another missive here talking about a decline in their prediction for U.S. GDP down to 1.6%. For this year. Now, the rise in the price of gold and gold shares has, of course, been a very happy event for us, notwithstanding today's decline. The gold shares are still up triple digits this year, and if Paul is right, we are just at the beginning, and in fact, today could be an excellent day to add to your portfolio. Well, after our first break, my friend Eric Coffin, he's a newsletter writer and one of the most savvy investors I know when it comes to junior mining industry, will be with me to talk about the next Metals Investor Forum that I will also be attending. I was a part of the one in Vancouver in May, and that was certainly one of the best junior mining conferences that I've ever attended. If you listen to Eric, I think you will understand why you might want to really consider attending this upcoming event that's going to be November 12th and 13th in Vancouver. So Eric will be with me after the first commercial break, but right now I am really delighted to have with me, as we have almost every week, Michael Oliver, Thank you for joining me again, Michael.
Great to be here, Jay.
Always good to have you, and just to tell my listeners, it's olivermsa.com, olivermsa.com, to learn more about Michael's work and how you might consider subscribing. Well, Michael, gold is getting hammered today. I saw it was down some $40 or something like that. Many of the mining executives that I speak with up there in Vancouver, they're worried sick about this decline, about this rapid decline that just seemed to come out of nowhere. Are you surprised by today's decline, and are you worried about a major downturn from here?
No, I'm not worried about a major downturn. And as of the close of last quarter, last Friday, we put out our weekend report and outlook for Q4, and we covered gold and the GDX, which is the gold mining, unlevered gold mining ETF. And we've been bullish on both of them. We turned bullish on gold in February at 1140 zone as it broke out on quarterly and annual momentum. And we turned very bullish on GDX, even more so, when it traded up to 15.5, 16 in February. Since then, GDX ran up to 31. Right now it's 23.5. We projected in the weekend report that probably the bottom, there's a zone of support for gold and GDX that we thought would probably roughly define the lows for this quarter. We're there. Mm-hmm. Had 1270, low 1270s as a gold area of support, and 23.5 for the GDX. Well, on the second day of the quarter, we're there. Okay. This is not a fresh break. See, people see the drop and they think, oh, this is a fresh drop. No, we've actually been under pressure in both those markets for about 3 months. Mm-hmm. So this is actually on an intermediate term trend basis. This is a fairly aged downtrend that's putting a stinger at the tail of the downtrend. And I think we're probably close to the low, if not at the low, for the quarter in both of them. I'm looking for now a minor sign of an upturn. I don't just want to assume that I know where support is. And MSA has been quite accurate on gold over the past decade or so. There's hardly a move we've missed. And frankly, if you're long gold at 1140, where we suggested, or GDX at 16, I wouldn't even blink an eye. The question, though, is for the person who is not in those markets at all and is looking to establish a position, I think if you see stability set in around these levels, any kind of upticks at all, basically about $20 in gold or $1 or $2 in GDX, I would assume, yes, in fact, that the support zone that we thought would occur is occurring, and I would establish a position. I think that the GDX in particular, if you run a point-and-figure chart, which is a price-based chart, it's very interesting what it just did. It topped at 30 on a rounded basis, $2 increment basis. There was an old high at 30 also on the way down. So what we set by pulling back $6, or 3 downticks on a $2 point-and-figure chart, is a pending triple-top breakout at 30. So if you ever go back to 30 again, you can bet you're going through. And I think you're going to do that. I think this pullback is a bullish pullback, not the start of a bear trend. And by the way, there's a lot of rattling going on in a lot of markets today. It's not just gold, T-bonds, right, stock, so forth. So all the tectonic plates are starting to move. And I think some of the moves are false in terms of the ultimate direction, but you're getting a lot of violence today.
Well, you certainly are, Michael, and I have to ask you about the T-bond, because here we have a day when the equity markets are down hard, and so are at least the T-bond, and I would imagine the German Bund and the JGB as well. Everything getting hit hard today. How do you account for both? I mean, we used, under normal circumstances, see money coming out of the equity markets going into the bond markets, but today money seems to be coming out of both, and they're not going into gold. Where's the money going, and what do you make of this?
It's going to the sidelines, but no, I think that the T-bond market is watch out here. There's we've defined an annual momentum trend breakage level below the market. Last month we traded was down to 165 and 10/30 seconds on the December T-bond futures, which is what we're looking at. Our number was 165, so they missed closing out the month at a bad level. They rallied back, closed to 168. This month we've raised our number to 166 and a quarter. I think we've traded about down to that level today, but that's a monthly close. I have a strong suspicion, this is only a suspicion, that what the bonds are doing is trying to spook the stock market into a spill. And if you get a little rapid spill in the S&P, like a quick 50-point drop or something, I think you'll find that the bonds rally back up again. Now, I don't think the rally's going to hold, but I think you'll get that flight to safety. So you'll get a divergence there for a period of time, if the bonds can provoke the S&P into a little mini panic, which is, I suspect, fairly close. specifically 2130 on the S&P cash. If you trade that, I think you're going to go into a little mini panic. Today's lowest, last I saw, was in the 2140s.
Yeah, indeed. And just looking at the T-bond now, I see it's 166 and 15/30 seconds. So we're right there at that number that you were talking about, right?
It's a good place to rally from, I think, for a fake-out rally, but nevertheless, one of these flight to safety jobs. Ultimately, we do think bonds are going to fail. The rates are going up. But if they can provoke the stock market into a little mini panic briefly, I think the bonds will get a reprieve. Everybody will think, well, they're going to hold, and they're not. But the rally, there's some reasons for the rally. Anyway, so a lot of big things are going on right now, and I think this is going to be a very important month.
Seems like a game of musical chairs to me, Michael. I don't know what's, when the music stops, what's going to happen.
Right. Yeah.
But I just have to ask you about the silver-gold ratio. You made a note of that as well. Mm-hmm. I guess silver is still outperforming gold, which is good signs for a continued bull market in the precious metals, right?
The spread relationship between the two, technically speaking, shifted favoring silver some months ago. Today we're getting the opposite of that. Silver's weaker than gold. But that you have to view in a larger context, and I think it's a rally in a dip for silver in a new uptrend favoring silver relative to gold. So I don't think it changes anything despite today's action. We already turned the corner in a major way, I think, favoring silver. So that's my view on that situation.
All right, Michael, you have been turning bullish, or at least have believed that we're nearing a point of bullishness for commodities. You still see it that way?
Yep, I still see it that way. I watched the Bloomberg Commodity Index, which used to be the Dow Jones UBS Index, and then Bloomberg bought it. It's a good balanced commodity index. It's not heavily weighted to oil like, for instance, the Goldman Sachs Commodity Index. So I watch it, and right now it's at a level that you cannot close the month here. If you do, you're going up. And I think you're going to rush to the upside about 20% in the commodity category. While we're getting a break in gold today, for example, you firmness in sugar, strength out of the meats, oil's pressing up at 49. There's a lot of things that aren't breaking down. And I think gold is the leader. It led the way out of the hole. And I think commodities as a package are tending now to gel and follow gold some 6 or so months after gold already made its first move. And I think that we're getting evidence of that. Also, the emerging markets relative to the S&P, the EEM is an ETF for emerging markets, have broken out relative to the S&P on a performance basis, which is another indication of commodity-related stock markets being favored against developed stock markets. And that's another indication of a commodity move pending.
Wonderful. Thank you very much, Michael, for being with us again and sharing your insights. Always good to have you, and we'll look to do it again next week if you're available. Thank you so much.